I'm Savannah Arroyo, and today I'm going to be talking a little bit about investing in multifamily real estate from the active side and the passive side. So, before we get started, I'm going to give you a little bit of background about myself. I am CEO and founder of Net Worth Nurse. I've been a registered nurse for over 8 years. I've worked in every specialty, I feel like. I went into nursing with the goal of becoming a CNO, a chief nursing officer, and got my master's degree early on and started climbing the corporate ladder. And so for my last 4 years in the healthcare system, I was serving as a supervisor and an assistant manager for different practices. And then at the beginning of 2020, after I had my second daughter, my priorities started shifting a little bit. And I started wanting to look for ways to generate multiple streams of income, to create some passive income, just so that I wasn't so reliant on my W-2 anymore. And so beginning of 2020, my husband and I started investing in real estate, and we didn't have any money to start investing. And so we pulled out the second mortgage on our primary home and bought two single family homes. And then they were only cash flowing a couple $100 a month. But after we bought those, we were looking to really scale our portfolio and started learning about multifamily real estate and syndication specifically, so that we could go out, raise capital, use other people's money to scale our portfolio. And so since then, I've raised over $3 million, mostly from healthcare professionals. We purchased 38 units in our first 6 months. We have 90 units total now for apartment complexes. And through Net Worth Nurse and my platform there, I've had the opportunity to coach dozens of healthcare professionals into their first investment, some as active investors, a lot of them as passive investors. And it's just been a really cool opportunity to give back, especially to the healthcare community. So diving into kind of the partnership breakdown of multifamily and syndications. So when people go into multifamily, they're most of the time not going into it on their own. And the way people are doing this is they're either breaking it down into a joint venture or syndication. So a joint venture is when two or more investors are coming together, really bringing equal value to the acquisition, either through skill set, capital, and they're splitting it pretty evenly, usually 50-50, or if it's four people, 25, 25, 25, 25. There's a lot of different ways to structure JVs. For instance, in a flip, you hear about this frequently, where someone's bringing capital, someone's bringing the sweat equity, they're partnering with someone who's bringing the capital, they're taking it and going out and finding the property, purchasing it, flipping it, and they're splitting in the profits 50-50. So that's one example of a joint venture. A syndication is people passively investing. So that's the biggest difference there. In a syndication, the operators are going out, or these are called general partners as well, going out, finding the deal, and then people are passively investing, just putting up the capital to take a very passive approach. And this is great for people who want to get involved in real estate, but don't necessarily want to be super active. It's a great opportunity for them to still be involved in real estate, still generate amazing returns, and not have to do a lot of work. So the split in syndications are usually 80-20 split, sometimes 70-30 split. And then you'll see this kind of broken down further if there are certain pref returns or things built into the deal. So that's kind of a broad overview of the differences between a joint venture and a syndication. And then I'm going to take it one step further and dive into the roles and responsibilities and the differences there. So general partners, commonly referred to as operators or JPs, they are the ones that are going out and finding the deal, acquiring it, getting the financing, raising the capital, getting the deal to close, and then managing it throughout the lifetime of the investment. So a very active role in the syndication. And then it really creates a perfect symbiotic relationship with the limited partners or passive investors, also called LPs. And they take a percentage of the deal based on how much capital they're contributing. So these syndications are usually purchased in an LLC, and then the general partners owning 20% of the LLC. And then the limited partners will own a percentage of that LLC based on how much capital they're contributing to the deal. So the biggest priority for a limited partner wanting to vet out the JP and the sponsorship team, the people who are actually running the deals. So for ways to get involved in the general partnership team. So I've broken down the general partnership team into a few more roles. So a balance sheet guarantor. This is someone who signs on the loan, 10 to 15%, very passive. KP is another name for it, a key principal or a sponsor, and they're really meeting the net worth liquidity requirements of the deal. So this is a hurdle, especially for newbie investors getting into it. You need a lot of experience to qualify for some of these multifamily loans. So, for example, agency debt or government loans, Fannie Mae, Freddie Mac. If you've heard of those, that's agency debt, and you need 2 years experience in multifamily before you even qualify for that. So you're probably wondering, how does a newbie get started in this? So you got to get creative. On our last deal, we used agency debt where you don't have the 2 years experience. And so we brought on a KP, gave him 10% of the general partnership just for signing on the loan. So you can see this is actually an amazing opportunity 10, 20 years into your real estate career. If you have the net worth liquidity, you're working with newbie investors wanting to get in their first syndications. This is a great opportunity that if you vet them out, you trust them, you can sign on the loan for them and earn 10, 15% of a general partnership without really doing anything. So huge opportunities there on both sides. And then moving into the asset management, this is a very active role in the syndication and earning usually 20 to 30%. So this is the person that's overseeing the investment throughout the lifetime of the investment. Usually the asset manager is managing the property managers as well as the contractors and the day-to-day of the building. The capital raiser. So this is bringing capital to the real estate deals, usually through private investors. And this usually earns a general partnership portion of 30, I've seen up to 50%, usually around 30%. So it depends on the capital contribution. And then this person usually has huge marketing efforts and relationship building. So these are the people you see with podcasts, with platforms. They're out educating investors on how real estate transactions work, mostly syndications or what kind of deals they're bringing to their investors. That's what they're out there talking about. And they're raising capital usually for other people's deals. So for instance, if you are a big syndication deal and there's a $5 million raise, it's not uncommon to see multiple capital raisers brought in. So you can have one capital raiser who's bringing in $2 million. They'll earn a portion of that capital raiser percentage based on that capital. You can have another one bringing $2 million and another one bringing $1 million. So you could have 3 capital raisers coming in a deal, and then that 30% is split amongst all 3 of them based on how much capital they actually brought to the deal. So this is a very powerful piece of multifamily real estate. If you have a platform or if you feel like you're good at talking to people, or if you know a lot of people who have capital ready to invest, they don't know where to put it. This is a huge opportunity that you can create a capital raising platform and then bring that capital to other general partner deals. So you can be a capital raiser and involved in multifamily syndications and not have to manage the asset and not have to contribute risk capital. There's ways that you can get involved outside of that. And then sourcing a deal. So finding the deal, getting it under contract, due diligence, closing. So 20 to 30% of the partnership. It really depends how involved they are. Some people who just bring a deal to a GP maybe earn 5%, 10%. It really depends. And this is another great way for someone to get involved who doesn't want to necessarily manage the asset, or maybe you can't bring capital to a deal, but you're really good at underwriting and you have great broker relationships and you're finding really great deals. If you find a really great deal and have relationships with general partnership teams, I mean, you could be working with 4 general partnership teams. It's a great way that you can get in and earn a portion of the GP. And what I've seen with even these deal finders, some operators will give them an acquisition fee. So if you're finding a $5 million deal, $10 million deal, for just finding the deal and earning a portion of the acquisition fee, you can easily earn 70, 80, maybe $100,000. So another great way to contribute to a JP team. And then looking into the risk capital. So when anyone gets these deals under contract, there is usually an earnest money deposit that has to be due. All the due diligence fees, that's travel going to the property, the contractor, anything that you're paying out of pocket for that. And then sometimes to tie down certain financing, some lenders will make you put like a good faith deposit. So the risk capital that's presented in these deals, it's called risk capital because if the deal doesn't make it to close, it'll be lost. And so that being able to present that capital to a deal usually earns a percentage of the general partnership team as well. So as you can see, there's a lot of different ways that you can be involved in a JP team without having to do every single piece of what it takes to run a syndication. So now I'm going to kind of talk through the team and what kind of relationships you need to create with people in the space in order to find and purchase and close on a multifamily real estate deal. So first, we're going to start with the broker realtor. This is who's going to be giving you your deals. This is difficult if you're a newbie coming into the space because they want to see some experience, and it can be hard to get them to take you seriously if you don't have any experience. So for us personally, I mean, we had only closed on 2 single family homes like a month prior before we started jumping into multifamily, but we would just tell brokers when we got on the phone with them, we have real estate in Atlanta, Georgia. We're looking to purchase a multifamily over here. This is what we're looking at. Here's our criteria. A good way to get them to take you seriously is just to be very specific on what you're looking for. So brokers are dealing with, dozens of investors. They're looking at deals. They're sending it to them, maybe not getting a lot of feedback. So for us, it was super important that when we got in front of a broker, that we were very specific with what we were looking for. For example, our first deal, we were looking for a 12 to 20 unit, $1 to $2 million price point in these 3 submarkets in Oregon and a strong value add deal. And we were able to work with a broker to get a deal. For that first deal, we probably talked to about 50 different brokers, got about maybe 5 to take us seriously. And then even with that, taking it a step further, we probably underwrote maybe 90 deals, submitted offers on 10, maybe 7 or so before we got our first one accepted. So it's great too. And then another good thing with brokers is as they're sending you deals, once you get them to start sending you deals, give them feedback within 24 to 48 hours because they're sending these deals out to a lot of people and not getting a lot of feedback. So even if the deal doesn't work for you, just giving them something as small as, this isn't going to work with our numbers. This won't work with our investors, or, there's not enough meat on the bone, or there's not enough value add opportunity here. Just even a one sentence of why it won't work. And I'm excited to see what else you have in your pipeline type thing, just to keep the communication open is huge with brokers. And then lenders and financing, another hard thing as a newbie coming into the space to get lenders to take you seriously. Like I said, bringing on a KP can kind of help you there. And that can help you with both the broker relationship and the lender financing. So if you know that you're going to go out and buy a multifamily deal and you're not going to be able to qualify for a loan on your own and that you're going to have to bring a key principal on, I would start having those conversations sooner rather than later. You can meet people at meetup groups, different masterminds. There's tons of different places and communities that you can meet KPs for your deals. And that'll be an important piece in this lender and financing as you start having those conversations as well. So as you go out and start looking for deals, you're going to want to get a good idea of what the financing is, because you're going to be underwriting deals. You're going to need to know the loan terms to input there. So you want to have some conversations open and initiated with some lenders in the space. And then just let them know, be very honest with your financials, what you're looking for. And good lenders will coach you through it if it's your first time. I haven't had really any issues with lenders in that piece. And then your property manager. So this is your boots on your ground. This is a super important person in the transactions. Most of the time for especially value add real estate, multifamily plays, you're replacing the property manager first. That's your biggest thing when you're taking over the buildings, because if the property manager was a good one, they would have been running the building most efficiently. The rents would have been increasing, the expenses would have been lower. And so for all of our deals, except for the last one, we've immediately replaced the property management team. And this is a good relationship to initiate early on as you start looking for deals in a specific market as well, because these people can help you double check your underwriting. You want to make sure, okay, if you're looking to raise rents 5, 6, 7% year after year, you're going to want to be touching base with the property manager to make sure that that's realistic with what they're seeing in the market. And then also what we always do is we have our property managers come with us when we go to do the due diligence and the inspections of the property, just so that they can see the property and what they're going to be getting themselves into. And then a CPA is super important, especially in multifamily, especially if you're raising capital and doing syndications. There's a lot of different ways that you can work the tax system to benefit yourself and your investors in real estate. And there's a lot of asset. I mean, it's a huge asset that you can depreciate, that you can do cost segregation studies. So there's a lot of ways that you can offset any of the income that's generated from the building. And using a really good CPA who's real estate savvy is very, very helpful there. And even if you don't qualify for a full-time real estate professional status and you're not getting all the returns in real estate, if you're raising capital and you have investors who are a full-time real estate professional, you need to be doing whatever it is to whatever is in the best interest of your investors. So even if the cost segregation studies don't necessarily benefit you as an operator, you're going to want to be doing them for your investors. And so working with a CPA to do that is huge. This is also very dependent on everyone's individual tax situation. So again, something to discuss with the CPA. Contractor, especially with value add deals, this is a very important relationship. This is someone that you want to work with your property management team. So usually your property management team, they have contractors they work with turns and doing different things around the building. And so using their recommendations and referrals is huge. In the space, they're always backed up. Contractors are backed up 3-6 months all the time, especially in the markets that we're in. So having those relationships with them is super important, especially as you're doing turns and different renovations on your property. And the biggest piece here is you're going to want to make sure that your communication style is working with the contractor. So contractors have all different communication styles, and you need to know as a operator with investors that you have real clear expectations on the project, especially around budget and timeline. And then moving into real estate SEC lawyer. So if you've never had to use a lawyer before for any real estate in multifamily and especially syndications, you have to. You have to structure the deals with legal paperwork. So for our first deal, we used a real estate lawyer who wasn't really familiar in syndications, and it created a lot of problems. Although he was very willing to help us and get the legal paperwork done for us, it was a lot of unnecessary hurdles that we had to cross, and we didn't know what we didn't know at the time, but it was a very painful process, and we didn't feel like it needed to be that painful. And it wasn't until I was venting about it at a real estate conference a couple of months afterwards, which again just shows the power of being networked in the community and talking to people and having those relationships. I was at a real estate conference talking about it to an SEC lawyer, and realized there was a way better way. And so now I use Calliser Law, Merrill Calliser. He's very well known in the real estate space. Him and his team are amazing. I can't say enough great things about them. And not only are they lawyers, but they're also investors themselves, which is a huge benefit for an operator, especially when they're structuring your legal documents, because they're very up to date with what's going on in the market and what the best practice is. And then a mentor, advisor, coach. This is something that we invested on early on when we moved into the multifamily space, because we were going to be raising capital from our friends and family, and we did not want to be in a position where we were losing anyone money. And so for us, it was worth it to pay for a $30,000 coaching program to kind of fast track our results, have a mentor, have a coach, helping us to prevent some of those mistakes. So not all coaching programs are that expensive. There are a lot of amazing ones out there. There's a lot of different masterminds and people who like to serve as mentors and advisors and coaches in a more informal way. But regardless, it's a great way to kind of fast track your results. So now we're going to dive into the numbers and look at how the value add model works in multifamily and why it's so powerful. So looking here, it's a 100-unit building, raising rents from 600 a unit up to 770 a unit. You could, and then also decreasing expenses from 400,000 a year to 350,000 a year. What you can see that does to a value of a $4 million property with those small changes, moving it into a $7.8 million property. So this is really just the power of multifamily, and really how you want to do that when you're looking at a property. You want to be super creative and looking for ways to increase the income and decrease expenses. So different ways that you can increase the income: increasing rents. You can add laundry, pet fees, application fees, parking fees, a lot of different ways that you can increase your income there. And then in terms of decreasing expenses, a lot of that comes from hiring new contracting services. Maybe it's implementing a new property management team, maybe implementing some water efficient features. There's a lot of different ways that you can decrease expenses in a multifamily building. And when you're doing underwriting for these, it's standard to get the last 3 years of P&Ls, unless you have a seller who has really bad bookkeeping, which does happen. Then you just kind of work with what you got. But those are actually really good opportunities for value add, because it's kind of a mess and you're going in there and cleaning things up. But looking at the last 3 years P&L, looking at the expenses and the income, as a savvy investor, you want to go in there and find different ways that you can be creative with it to increase the income, to decrease expenses. And then what that does in the value add model is very, very powerful, especially the higher count that you get in units. So we're going to look at some sample returns. These are for passive investors in a syndication deal. So these are super important for you to know, even if you want to take an active approach, because this is how you're going to be talking to all your investors and what type of returns they're going to be getting. So super important that you know. So we have it broken down into a $50,000 investment and a $100,000 investment. We always show both when we do our presentations, because those are kind of the two major buy-ins when people come in, is at 50 or 100, and then increments there for after. So you can see the cash flow in the green. For a value add deal, it's smaller at first, and then it does increase year after year as the building begins to stabilize. And with the syndications, the majority of the capital is returned either with a sell or a refinance. So we'll talk about fees a little bit later on, but the biggest way that passive investors and operators are making money is through major capital transactions, including a refinance or a sell. So as you can see here, the sell is for the $50,000 investor. They're getting their member capital returned, the $50,000 here, plus another $28,000 on top of that. And then they received $23,000 of cash flow throughout the 5 years. And so they're totaling over $52,000 on top of the $50,000. So it's over 100% return on investment. And then we have it down here for the $100,000 investment. So I'm going to dive into a sample deal analysis. So this is the last deal we did. It was a 36 unit deal up in Oregon. The current rents when we took it over were 970. Market average was 1,100. So big opportunity there to increase rents without doing anything. This is a very stabilized building and pretty up to date. And so we're going to be able to increase rents drastically. 5%. So we're going to increase rents to the state max for the first 2 years, which for Oregon in 2023, it's 9.1%. So we're going to increase it the max the first 2 years, and then 5% years 3 through 5. So you do need to check market rents and see what's reasonable. This is reasonable for Oregon. It's what we're doing on all of our other buildings. It might seem aggressive, but with inflation right now, it is very doable. So what you can see it does to the income and the expenses and the overall NOI, how that increases year after year. And then our expenses, we still keep pretty minimal. So overall in this building, we're looking at an average annualized return of 21%. This is my biggest push to investors when I'm talking to them about what value a syndication deal has. Most people are invested in stocks and index funds, which are earning them about 7% year after year. And so this is a huge opportunity to grow wealth at a bigger scale and also diversify investments. And then you can see the return on investment for this one is 108%. So for a $100,000 investment, this is kind of what the cash flow looks like year after year, with year 5 sell getting that $100,000 back plus another $72,000 on top of that. So you can see this is pretty powerful for even passive investors. I have passive investors that are in like three of my deals. So as you can see, as we start selling them off, they're going to be in a really good position to collect some of that passive income. So now I'm going to talk a little bit about the general partner returns and the breakdowns there. So the general partners of the deal are earning the majority of their returns through fees. And this is normal for all kind of financial transactions, different asset managers and such taking fees, no different in syndications. So these are some of the fees commonly seen: acquisition fee, a capital transaction fee. So this can be any type of occurrence in the transaction where capital is getting moved around. They can sometimes use the term interchangeably with a refinance fee and a disposition fee, which is more an exit fee, and then a refinance, obviously, when a refinance comes. And then some syndicators will charge a construction management fee if it's a heavy value add, if there's a lot going on it. So this is where the operators are making a lot of their money. So as a passive investor, you want to look at all the fees that your operating team is taking, and it should be very apparent in the presentation that they give you where all the fees are. If they're not, if they're hidden and you have to ask for them, that is a red flag. We show all of the fees that we're taking early in our presentation so our investors know exactly where we're getting paid out. And, taking an acquisition fee for the property is very standard because there's so much work that goes into getting these deals to close. I mean, it takes anywhere between 30, 60, 90 days. Our last project took 5 months. So taking an acquisition fee is very fair for operators, and not most operators aren't taking all of these fees. For us, we take an acquisition fee and an asset management fee that I'll show you guys in the next slide, what that kind of looks like. But again, I just want to show you here how powerful these fees can be if you're wanting to take an active approach in these deals. So for an acquisition fee of $1 million property, that's $10,000 that you're getting cash pretty much when you close the deal. So for a $5 million property, that can be $50,000 back into your pocket. And we've gotten really creative with our acquisition fees of lumping, because we don't really necessarily need the capital right now. So we'll lump our acquisition fees back into the project, and then it'll earn us more cash flow for some of the returns. But as you can see, the bigger deals you start doing, if you get a $50 million deal, that's a $500,000 acquisition fee. Oh, that's only 1%. Most of these operators are taking 2-3%. So it could be triple that, $1.5 million in an acquisition fee that's paid out to the general partnership team. So back that first slide I showed you guys, the acquisition fee, depending on how it's structured, and the operating team will kind of determine that, the acquisition fee is split amongst those people. So sometimes capital raisers get a piece of the acquisition fee. Some of the KPs get a piece of that. Anyone kind of involved in the general partnership is usually receiving a piece of the acquisition fee. So what that kind of looks like in that last deal that we did, the 36 unit, again, what it kind of looks like from a general partnership side. So we take a 1% asset management fee, and then we took a 1% acquisition fee. So when we closed on the building, we took $45,000. And then what our cash flow looks like year after year. This is from the 80-20 split. So the syndications, how we structure our deals as a general partnership, we take 20%. And so the distributions from cash flow, this is seen from the 20% that's coming out every year. So how it works is once all the income is received and the expenses are paid, what's left over is the cash flow. And then that's what is distributed to the team, 80% to the investors, 20% to the general partnership team. So that's where the cash flow is coming here each year. And then I have it broken down a little bit further here. So the 20% equity plus the asset management fee plus the acquisition fee. So as you can see, year 1 totaling $74,000, year 5 $322,000. So and then total earning $466,000. So as you can see, these can be very, very powerful for scaling your portfolio and also earning income on the general partnership team. This is something that when we got started in this, we were thinking, okay, if we do 2 of these a year, by the time we get to 3 to 5 years and they start selling off and we're buying more, that's when it really starts snowballing. So you can see a huge way that you can grow wealth with these deals. I just want to touch on the SEC regulations briefly. There is a difference between who can invest in these deals between accredited investors and sophisticated investors. Sophisticated investors are also commonly referred to unaccredited investors. So you have your accredited, unaccredited. There's certain criteria for each one. And then based on this criteria, it allows you to invest in different offerings. So unaccredited investors can only invest in 506B deals, and accredited investors can invest in both 506B and 506C deals. This is super important information for you to know as a passive investor, as an active investor. So as a passive investor, you're wanting to invest in syndications and you're unaccredited. What do? You need to start creating relationships with operators and people who are buying and doing these syndications and who have it in a 506B. So who take unaccredited investors. So we do that. All of our deals are 506B. We like to have relationships with all of our investors. And also we like to allow unaccredited investors to still participate in these syndication deals because we feel like they're such a powerful proponent for growing wealth passively. And it's, we want to be able to give that opportunity to unaccredited investors as well. But what that means is we can't publicly advertise it on social media or TV or billboards, anything like that. So when we have deals, we can't be on Instagram telling everyone in the world about them. So our investors hear about them through our investor portal because we have a relationship with them. So if you're wanting to invest passively in syndications, for instance, how you do it with us is you head over to our website, you go to the Willow Investment Group page. You can get on our portal, see all of our past, current, and future offerings, and then you'll have an opportunity to set up a call so that we can get to know you. And then if you want to raise capital, what this means is you need to determine if you're going to be raising from unaccredited investors or accredited investors, or if you're going to be raising from both, and then how you're going to be talking about real estate and how you're going to be connecting with these investors will be dependent on that. So this is really just scratching the surface on SEC regulations. There is a very complex topic and something super important that you need to know if you're going to be raising capital. And so how I talk to investors, I'm going to just kind of run through a sample script. I had a lot of people ask me kind of how I do this. I have it pretty much memorized at this point, but when I get on the phone with an investor, I ask them their experience investing in syndications, and most of the time they don't have any. So what I'll do is I'll explain. So what we're doing is we're going out and buying apartments and we're flipping them over a 3 to 5 year period. We are raising money from passive investors who want to participate in the deals, and we're cashing them out along the way. My husband and I are on the operating team. We own 90 units. We have 4 apartment buildings. We have great relationships with brokers. We do 2 to 3 deals a year. If you're interested in investing with us, what we'll do is we'll get you onto our portal. On the portal, you'll have access to all of our past deals. You can see our past presentations and what type of returns we're earning for our investors on those deals. And then this is where you'll get first notified of any upcoming opportunities. So if we have a new opportunity for investment, we'll send out an email to our email list, and then we'll also send it out on the portal to our investors who we already have a relationship with and who we know are interested in investing with us. And then from there, they'll have access to a presentation that I create on the property. It's a PowerPoint, usually, 10, 20 slides. I talk about the market, why we love the market, what we're seeing there. We talk about the building, what opportunities are there, what the numbers look like, next steps and timeline. And then we talk about frequently asked questions, and then the numbers. We talk through what investors can expect to what returns they can expect by investing in our syndication, both at a $50,000 minimum and $100,000, and what that kind of looks like cash flow projected pro forma. And then if you're looking through the presentation and everything looks good, then you can commit to the deal directly on the portal. It is a first come, first serve basis. Priority goes to repeat investors. But once you commit to the investment, then you get access to all the legal documents. And this is about 100 pages of legal documents. It's pretty extensive. If you've never invested in a syndication, it can be a little bit overwhelming and daunting. We allow our investors up to a week to review all the legal documents. I have maybe a couple investors, less than 3% of my investors actually take these documents to be reviewed by another lawyer. They're pretty straightforward in this space, and it's really kind of dependent on the legal team that you're working with. So we showcase our legal team and who we're working with and their track record. Once our investors review the legal documents, there's some signatures and a questionnaire that they have to complete. It gets saved directly into their portal. It's all electronically signed, and then they'll have access to the wire information. And then through the wire information, they'll connect their bank to the portal through an ACH, and then they'll deposit the wire directly through the account there. And then that claims their spot in the investment. Then we'll update our investors when we actually close on the investment offering, and then what the communication looks like thereafter. So we do quarterly updates with our investors at minimum. So at least every quarter we're getting in front of a camera talking. We prepare like a 3 to 5 PowerPoint slide, nothing super crazy, but just pictures and updates and kind of how our numbers are looking. And we run through that. My husband and I roll through that with on video for our investors. We also provide the PDF, a PowerPoint, and also the access to all the financials. So we're super transparent with our financials. We have the P&Ls for each quarter attached to our quarterly distribution. And to be honest, probably less than 10% of my investors actually open it and look at it. The majority of my investors love being very passive. And so they see that deposit show up in their checking account every quarter, and they're happy with that. And so it really depends on your investors and kind of what they're wanting. But we do create quarterly communications we're really want to be transparent and give our investors the most up-to-date information with what's going on in the property. And then anything that happens in between the quarters, like if we're replacing a roof or doing new projects, we post it up on our portal. And then also I'm super active on social media. So anytime I'm visiting our properties, I'm showing a bunch of stories and stuff on Instagram. So that's kind of how I walk through it with investors. Also touch on the return. So we're looking to hold these investments 3 to 5 years. We're looking to double our investors' money in that time. So a $50,000 investment, we're looking to get you your $50,000 in cash flow on a quarterly basis, plus another $50,000 return of sale. And so we're looking at over 100% return on investment for our investments. We're looking at around 20% on average annualized return. And this is the number that you do want to compare to the stock market. And we look for cash on cash return anywhere between 7 and 9%. And then really just lastly touching on syndications and appealing to passive versus active investors. So passive investors, this is huge for working professionals. I have tons of, docs and nurses, other healthcare related pharmacists who are really busy and just want to participate very passively in these deals. Great opportunity for them to do so. People have a low risk tolerance, people looking to diversify their investments, people wanting to be very hands off. So if that's you, great opportunity to passively invest in syndication deals. I also have a lot of people who are active in real estate investments. So they either own short-term rentals or maybe they own some long-term rentals, and they also want to take some of that capital that they're getting in cash flow from some of those other opportunities and put it passively in these syndications to generate some other disbursement. So great way to do that as well. And then for active investors, really the ability to bring a needed skill to a team. And like I really tried to emphasize in the beginning slides, like you don't have to do it all. You can have a skill, a very solid skill, an underwriting skill, a capital raising skill. Maybe you love putting up the risk capital, or maybe you're further along in your career. You have a very high net worth liquidity and you can just sign on deals as a KP. Lots of different opportunities that you can bring in a skill to a JP team. People looking to scale a portfolio, syndications are a great way to do that. Just working with a team in general. I mean, if you can work with 30 people to go out and buy 500 units, you could potentially scale a lot faster than buying a long-term rental every year on your own. So Must be able to work in a team when you move into syndication. So, especially for people who are in the long-term rental space or short-term rental space and they're wanting to move into a syndication, you have to be able to work on a team because you're going to be working with a lot of different people in a lot of different capacities. And so, it's super important that you have good communication skills and you can work together. And then wanting to be a hands-on investor. So syndications, if you're wanting to be an active GP role, it's really wanting to be hands-on on the deal in whatever capacity that looks like. And that is it. So I hope that gives you all a better understanding of kind of the inside look of how syndications work and function, either from an active role and a passive role. I have a lot of people who are interested in both. And so I tried to make this presentation appeal to both sides of the coin. I also have a lot of investors who invest passively in their first couple of syndications and then they go out to do them on their own. We've worked with people like that. We've brought them on our loans, on our GP team, just to give them kind of some of that experience that they need to go and do their own deals on their own. So a lot of different opportunity here. I have my website and my email on here. I love connecting with people about real estate investing. If you want to check out our passive investments, head over to our website and then go to the Willow Investment. You can log on to the portal, set up a call with me. I'd love to connect. And then if you're even wanting to take a more active approach, I do coaching. I've done coaching on capital raising. My husband does coaching on underwriting and broker relations. So would love to connect with you if you're interested in that. We're also everywhere on social media. So TikTok, Twitter, LinkedIn, Instagram, YouTube, and Facebook. So if you're interested in kind of what we're doing and following along, please check out our social medias. Thank you.